Hello, welcome to Capital Sensei. Today, we're going to dive deep into a fascinating book called Free Capital, written by Guy Thomas. We'll unpack the strategies and, more importantly, the mindsets of 12 ordinary private investors who managed to make millions in the stock market. We'll explore what free capital actually means, the contrarian thinking they all shared, their obsession with deep research, and the incredible emotional discipline that set them apart from the crowd. We try to answer questions in the comments whenever possible. So, if anything we discuss today sparks a question, or if you have your own investing story or struggle to share, please leave a comment. Your experiences help everyone else learn, and together we can build a really knowledgeable community. So, let's get started. The author, Guy Thomas, is an interesting character himself. He wasn't some Wall Street guru, but an academic from Cambridge University. He got tired of the theoretical models taught in business schools, which often don't seem to match up with reality. He wanted to know how real people operating from their own homes with their own money actually managed to beat the market, and beat it consistently. So he went on a quest to find and interview them. The book's title, Free Capital, is a concept we need to understand right away because it's central to everything else. It doesn't mean money you found on the street. Think of it like this. Imagine you go to a casino with $500 of your own money. You're tense, you're careful, every loss hurts. But what if you win $5,000? Now, you can take your original $500, put it back in your pocket, and continue playing with the house's money. That's free capital. This house money is capital that you've already won from the market. It's profit. Psychologically, this changes the game completely. The investors Thomas interviewed reached a point where their investment portfolio was funded entirely by their past winnings. This gave them an immense psychological advantage. They could take bigger risks, hold on during terrifying market crashes, and make decisions with a level of detachment that most of us can only dream of. It's a powerful feedback loop. Success breeds a mindset that leads to even more success. One of the most powerful threads running through all 12 stories is the idea of being a contrarian. This means deliberately thinking and acting against the prevailing market sentiment. When everyone is panicking and selling, the contrarian is calmly looking for bargains. When everyone is euphoric and buying, the contrarian is getting skeptical and maybe even selling. It sounds simple, but in practice, it's one of the hardest things to do in investing. Think of the market like a big crowded party on a boat. When the music is loud and everyone is dancing on one side, the boat starts to tilt dangerously. The smart investor doesn't join the crowd. They quietly move to the other side of the boat to keep it balanced, knowing that eventually the crowd will have to shift back. These investors weren't just contrarian for the sake of being different. They did it because they understood that the biggest profits are found where nobody else is looking. Of course, you can't be a successful contrarian by just guessing. This leads to the second major theme, an almost fanatical dedication to deep, independent research. None of these 12 investors were listening to the hot tips on television or blindly following analyst reports. They were detectives, digging for clues that the rest of the market had overlooked. They were looking for what investors call an edge. What does this edge look like in practice? For some, it meant becoming an expert in a very specific, boring industry that Wall Street ignored. One investor focused on small, obscure engineering firms. He would read their technical manuals and annual reports with a level of detail that would put most people to sleep. But in those boring documents, he found companies that were fundamentally cheap and poised for growth. For others, The research was more hands-on. One investor, before buying stock in a retail company, would visit their stores in different cities. He'd talk to the staff, observe the customers, and check the inventory levels. He was doing on-the-ground journalism to verify if the company's story matched reality. This kind of work gives you a level of conviction that you can never get from just looking at a stock chart. When the market panics, you can hold on because your knowledge isn't based on someone else's opinion, but on your own hard-earned facts. This deep research is what gives you the courage to make another type of unconventional move: running a concentrated portfolio. The standard advice you hear everywhere is diversify, diversify, diversify. Spread your money across dozens or even hundreds of stocks so that if one fails, it doesn't hurt you too much. The investors in free capital did the exact opposite. They would often put a huge percentage of their net worth, sometimes over 25%, into a single stock. Now, this sounds incredibly risky, and it is, but it's a calculated risk. Imagine you're a general in an army. You could spread your troops thinly across a huge front line, or you could concentrate your best soldiers to attack one single critical point. A concentrated attack is riskier, but if it succeeds, the victory is decisive. These investors did so much research that they felt they knew a handful of companies better than almost anyone else. They were making big, concentrated bets on their absolute best ideas. This isn't a strategy for everyone, and it's certainly not for beginners, but it highlights a key principle. For massive returns, you need to have the courage of your convictions. Spreading your money too thin, or diversifying as Peter Lynch called it, can mean that even when you're right, the impact on your portfolio is so small that it barely matters. These investors understood that finding one or two truly great opportunities in a decade was enough to build a fortune. Now, let's talk about the absolute bedrock of their success, the one thing that underpins everything else: emotional discipline. You can have the best research and the most brilliant contrarian idea in the world, but if you panic when your stock drops by 30%, none of it matters. The market is a roller coaster of fear and greed, and most people are slaves to those emotions. The legendary investor Benjamin Graham created a brilliant analogy for this. He said to imagine you are business partners with a moody guy named Mr. Market. Every day, he comes to you and offers to either buy your shares or sell you his. Some days, he's euphoric and offers you ridiculously high prices. On those days, you might consider selling to him. Other days, he's deeply depressed and offers to sell you his shares for pennies on the dollar. On those days, you should be eager to buy from him. The key is that you are in control. You don't have to trade with him. You can ignore him completely. The problem is, most people let Mr. Market's mood dictate their own. When he's panicking, they panic. When he's greedy, they get greedy. The successful investors in free capital had mastered the art of treating Mr. Market as a useful, but emotionally unstable servant, not as a master. They used his manic-depressive mood swings to their advantage. This emotional control is especially crucial when things go wrong, and they always do. Every single one of these investors had stories of investments that went south, of stocks that lost 50% or more of their value. The difference is how they reacted. A typical investor sees a 50% loss and thinks, "I've lost half my money. I need to sell before it goes to zero." They crystallize a paper loss into a real one. The investors Thomas profiled had a different thought process. Because their conviction was based on deep research, their first question wasn't, "Should I sell?" but, "Has the fundamental story of the business changed?" If their original research was still valid and the market was just being irrational, They would often see the price drop as a golden opportunity to buy even more at a cheaper price. This ability to not just withstand pain, but to use it as an opportunity is a rare and incredibly valuable skill. Another common trait was their immense patience and long-term perspective. These were not day traders trying to scalp a few cents of profit. They were business owners who happened to transact through the stock market. When they bought a stock, they were mentally prepared to hold it for 5, 10, or even more years. They understood that true wealth creation doesn't happen overnight. It's the result of compound interest working its magic over very long periods. Think of it like planting a tree versus picking flowers. A day trader is like someone frantically picking flowers. They get a quick, small bloom, but the plant is gone. A long-term investor is like someone who plants a sapling. For years, it might not look like much. It will face storms and droughts. But if you nurture it and have patience, it will grow into a massive, fruit-bearing tree that provides shade and value for decades. These investors were planting oak trees, not picking daisies. This long-term view also helped with their emotional discipline. If you're checking your portfolio every day, you're going to be whipsawed by the market's daily noise. It's like weighing yourself every hour when you're on a diet. The small fluctuations will drive you crazy. But if you only weigh yourself once a month, you'll see the real underlying trend. These investors focused on the long-term business performance, not the short-term stock price wiggles. Let's dig into a couple of the anonymized investor profiles to make this more concrete. One investor, called the Geologist, had a fascinating approach. He applied his scientific training to investing. He would systematically gather data, form a hypothesis about a company's value, and then look for evidence to disprove his own hypothesis. This is a critical point. He was actively trying to prove himself wrong. Most people do the opposite. They look for information that confirms what they already believe, a behavior known as confirmation bias. By trying to poke holes in his own investment thesis, the Geologist ensured that the ideas that survived this rigorous process were incredibly robust. He wasn't emotionally attached to being right. He was attached to finding the truth. This scientific detachment allowed him to cut his losses quickly when the facts changed, but hold with granite-like conviction when his thesis remained intact. Another investor, dubbed the Entrepreneur, treated his stock portfolio like a collection of small businesses he owned. He wasn't interested in complex financial engineering or macroeconomic forecasts. He was interested in simple, understandable businesses with a durable competitive advantage, or a moat, as Warren Buffett would call it. He wanted to know, does this company sell a product that people will still need in 20 years? Does it have strong pricing power? Is the management honest and capable? His approach was refreshingly simple. He said that if he couldn't explain what a company did and why it was a good investment to a 10-year-old in a few sentences, he wouldn't invest. This forced clarity of thought is a powerful tool. It cuts through the jargon and complexity that often obscures the simple, fundamental questions that truly matter for long-term success. He wasn't buying ticker symbols. He was buying pieces of real, breathing businesses. What's really striking when you read these stories is how different their personalities were. Some were outgoing, some were reclusive. Some had PhDs, others never finished college. Their paths to success were unique, but they all shared this core DNA of independent thought, deep work, emotional control, and patience. They weren't playing the same game as everyone else. While the crowd was sprinting in a marathon, they were methodically walking, conserving their energy, and ultimately finishing far ahead. So, how does the concept of free capital tie all of this together? It acts as both a reward and an enabler. They're successful contrarian strategies generated the initial profits. These profits then became their free capital. This cushion of house money then enabled them to be even more bold. It made it easier to hold a concentrated position through a downturn. It made it easier to take a contrarian stance when everyone was screaming that they were wrong. It removed the desperate need to be right on every single trade. This psychological freedom is perhaps the biggest edge of all. When you're not investing with scared money you need for next month's rent or your kids' tuition, you can think more clearly and rationally. This is a profound lesson for any investor. Your first goal should be to build a base of capital that is secure, and only then should you take calculated risks with money you can afford to lose. These investors took that principle to the extreme, eventually playing only with their winnings. It's also important to note what these investors didn't do. They didn't pay much attention to broad economic forecasts. They knew that trying to predict recessions or interest rate movements was a fool's game. They focused on what they could control, the analysis of individual companies. They operated at the micro level, studying specific businesses, not at the macro level, guessing the direction of the entire economy. They also weren't trying to time the market perfectly. They didn't believe they could consistently buy at the absolute bottom and sell at the absolute top. Instead, they focused on buying businesses for significantly less than their intrinsic value. They understood that if you buy a $1 bill for 50 cents, you don't need to be a genius to make money. You just need to be patient and wait for the market to recognize its true value. This focus on value, rather than on price momentum or market trends, is another key differentiator. The market is often a popularity contest in the short term, but it's a weighing machine in the long term. Fads come and go, but real, underlying business value is what ultimately drives long-term returns. These 12 investors were experts at weighing businesses, while the rest of the market was just voting on their popularity. Let's think about the practical takeaways for someone starting out. You're probably not going to start with a 100% free capital portfolio, but you can adopt the mindset. First, educate yourself. Don't just follow tips. Pick an industry you find interesting, even if it's just a hobby, and start learning about the companies within it. Read their annual reports, understand their business models, develop a circle of competence. Second, start small. You don't need to take massive, concentrated bets right away. But as you build your knowledge and conviction, you can begin to place more meaningful wagers on your best ideas. Maybe your portfolio is 90% in a safe, diversified index fund, and 10% is for your detective work stocks. This allows you to practice these skills without risking your financial security. Third, practice emotional awareness. The next time the market has a big drop, pay attention to how you feel. Do you feel the urge to panic and sell everything? Acknowledge that feeling, but don't act on it. Instead, go back to your research. Is anything fundamentally different about the companies you own? This is how you build the muscle of emotional discipline over time. It's a skill, and like any skill, it requires practice. Fourth, cultivate patience. In our world of instant gratification, this is tough, but wealth in the stock market is a reward for patience. Stop checking your portfolio every day. Think in terms of years and decades, not days and weeks. The more you can detach from the short-term noise, the better your long-term decisions will be. The stories in Free Capital are so powerful because they are about real people. They demonstrate that you don't need a fancy degree from an Ivy League school or a corner office on Wall Street to succeed in investing. What you need is a specific temperament. You need to be curious, hardworking, independent-minded, and emotionally resilient. You need to be comfortable with being lonely in your opinions. These 12 investors essentially built their own small, highly specialized investment firms, with themselves as the sole analyst and portfolio manager. They weren't swayed by committee decisions or the pressure to match a benchmark index every quarter. They had the freedom to think for themselves and act decisively, a freedom that many professional money managers, ironically, do not have. The book serves as a powerful antidote to the idea that the market is a perfectly efficient machine where it's impossible to gain an edge. It clearly is not. The market is made up of human beings driven by fear and greed. And that human element constantly creates opportunities for those who can remain rational and disciplined. The inefficiencies are not in the numbers. They are in the human psychology that drives the numbers. In essence, Guy Thomas's journey to find these investors revealed a blueprint. It's not a get-rich-quick formula, but a guide to a state of mind. It's about finding an informational advantage through hard work, having the contrarian courage to act on it, placing significant bets on your best ideas, and having the stoic patience and emotional fortitude to see them through. And all of this is made easier once you reach that psychological nirvana of investing with free capital. So, the next time you hear someone on television shouting about the next hot stock, or see the market plunging and feel that knot of fear in your stomach, think about these 12 investors. Think about the quiet, methodical work they were doing in the background. They weren't reacting to the noise. They were creating their own signal, based on their own research and their own unbreakable conviction. That is the true path to turning market speculation into a wealth creation engine.